Welcome back, folks, to the crapshoot of a rambling madman revealing his over $350,000 stock portfolio, trading down a whopping $25,000. Actually, realistically, not that bad to the apes and the diamond handers that currently exist in the market. But on top of that transparency, I'm going to be revealing to you the 3 stocks that I'm most enticed to buy in this market sell-off, as I always find myself reverting back to my mean. As Warren Buffett says, idiots diversify. And honestly, if you're going to over diversify, just buy an ETF. I live in my parents' basement, folks. I have somehow outperformed the likes of Cathie Wood, hitting 30 to 40% returns year over year, which is just absolutely absurd for somebody with no financial degree. And if you enjoy this as entertainment value, don't take it as financial advice though, but consider hitting that like button as we dive right into this, folks. And let's start off with the corporate account, my newest account that I launched off as of May, which is still trading up 8.76%, surprisingly surviving somewhat of the volatility, not even a year deep into this account yet, but we're currently worth $76,500 from a mid 80,000 all-time high. And as mentioned, I have over $1,000 in dividends streamed between all my different brokerage accounts we're about to look at, and maybe you can help me figure out what stocks I should be allocating them to. But for right now, $206 in dividends, with my Canadian stocks only holding up thanks to Royal Bank. That purchase was a smart one, considering I'm now red on Granite and I have been red on Algonquin since the beginning. But because I primarily focus those as dividend plays, I'm not nearly as concerned about where the current price targets are running up and down to. Now, on the tech side of this, everything's actually pretty good. I mean, Google's still in the green somehow, and since I rebought back Facebook and continued to add to it, average buy $327, I am down about 6.51% in this account. But Tesla's still up 40%, and honestly, Tesla needs to pull back more. Now let's take a look at my RRSP. This is my long-term registered retirement savings plan account with over $600 in Canadian dividends, but $532 in USDs. And I'm finally red on my S&P 500 index as it reverts back down to those October highs. So it's going to be neat to see if the S&P continues to sell off, but this is looking pretty juicy from a standpoint of beginning to cost average in. Let's talk about my managed account before we reveal the largest tax-free savings account where all my money primarily sits. I got $204 that is fully taxable in this account, by the way, but everything's green in here. I've been in this market for a long time, folks. I can stomach the volatility and the insanity that you're witnessing, but if you're new to the market, hopefully you can find solace in my chill as a cucumber attitude, because you're going to have to. You won't have much of a choice unless you plan on capital loss actualizing, which is never fun. But take a look. I mean, everything's been pretty good. TELUS hit an all-time high, pulled back. Everything else has just been generally doing fine in this account, nothing crazy. But where everything gets interesting is in the TFSA that used to be worth almost $180,000, now $166,000, with over $330 in dividends here since kind of kicking off the year. And taking a look, guys, I made a huge purchase at the beginning of the year with TD, Toronto Dominion Bank, and that one's been doing good. I'm actually still up from the initial purchase that I made with this one, and it's kind of cushioning the blow that I've had from the Meta purchase, the Facebook purchase. And again, these shares were just purchased at $340. I could have waited a little longer, but only down $250. But like I said, guys, when you got a $17 buy price on average for Apple and $103 average buy price on Microsoft, I'm not really too worried about the fluctuations with those guys. But again, even in this account, I am now down on the S&P since I started purchasing it last year. Now, putting the accounts aside, guys, let's talk about my first and foremost most bullish stock that still trades as the cheapest S&P top 10 as I revert back to my mean. I need to stop buying this company, but somehow I'm getting more and more intrigued every day it drops closer to the $300 mark. This company regularly will do 30% pullbacks, and every single time, guys, it has been one hell of a good buying opportunity. And I feel like we're setting up for that right now, as Facebook hasn't reached that 30% pullback yet, but we're about 19-20% down. And this is all because Facebook is just crushing it on the forward looking ideas, right? Like they plan on launching a NFT platform where you can buy, sell, trade, and showcase your NFTs on Facebook, perhaps Instagram, and some of the other platforms there, which is absolutely brilliant and intriguing, considering right now the NFT market is largely controlled by OpenSea and primarily just one or two other NFT platforms. And I know Coinbase is going to be launching theirs sometime mid this year, but this is insanely bullish, I think, for Facebook to be doing, because right now NFTs are kind of a social stunt for most people, and they want to show them off. So, and considering most of them screen cap them and use them as their avatars anyways, it's a great idea, right? But the funniest thing I ran into recently, guys, is that the Sony PlayStation inventor basically thinks that the metaverse is pointless. When I saw this, I couldn't help but laugh my ass off. He kind of made a quote saying, being in the real world is very important, but the metaverse is about making quasi-real in the virtual world, and I can't see the point of doing it, which is hilarious. Headsets would isolate you from the real world, and I can't agree with that, he continued. Headsets are simply annoying. Now, this guy sounds like every boomer I've ever heard talk about Web3 or the metaverse, because they're like, oh, the metaverse already existed. Facebook can't own that. Obviously, back in the 90s, when I used to play video games, you had a character, a little thing above your head for a name, and then you had a mic set, and that's the metaverse, and it's still the same thing today. It's like, no, it's not, you complete and utter idiot. Every metaverse platform operates off two major facets right now, either software or hardware. The hardware of augmented and virtual reality still has my attention, like, what am I, 2 or 3 months deep now into the Oculus headset here, guys, and I still use this thing 3 or 4 nights a week, playing with you subscribers in poker, playing a ton of fun stuff and finding something new to excite me all the time. It's still a crazy piece of technology in my opinion, but the Web3 is what idiots are missing out on that Facebook recognizes, and that is the emergence of basically something that connects all the metaverse platforms together, and that is what we're going to see with blockchain technology. We're going to see that with games like Illuvium. We're going to see that with things like Star Atlas, where you're going to actually be able to pull out these NFTs from the actual game that are usable NFTs in the metaverse platforms and trade them outside of those platforms and move them to different platforms. I don't think people understand how big of a deal that is going to be in the movie industry and everywhere else, and whoever figures that out, that's going to connect the Web3 platforms, is going to get rich. And I'm glad that Facebook is largely a part of that. And this idiot clearly can't go on Google Trends, this boomer, and look up Xbox, PlayStation, and Quest or Oculus and start realizing that, hey, the Oculus over Christmas was just as popular as the PlayStation. But guess what? Couldn't get your hands on a PlayStation because they're sold out insanely, right? Yet Oculus is, I'm going to be really intrigued to see the earnings coming out, because that's what's going to really help us resemble and see what the saturation in the market looks like for the Oculus. So that's February 2nd. Very kind of keeping my attention on this, because I do have some fears of lowered guidance based off the obviously the advertising and the users on these kind of more dinosaur kind of platforms, which is Facebook and Instagram. I think they're going to be around for a long time, but YouTube, Facebook, Instagram are all competing with TikTok right now, and that is without exception. TikTok has surpassed watch time and so many user interaction analytics over Google and Facebook. So there's competition, but I think Facebook knows what they're doing here, and I'm putting a lot of faith in them. All right, that's why it's the largest position in my portfolio, leading me to numero dos. Kind of reverting back to the mean on Tesla, guys. I always kind of get steered away, and I constantly start thinking about things like Nvidia, which I'm still kind of intrigued by, but I always get reverted back. If I had to pick one today, Tesla makes the top of the list. I honestly think this is a future value growth play, and I think people constantly go back to the 2019 time period and act exactly the same, where they're just like, it's overvalued, it's this, it's that, and it's like those idiots missed the 0 inning, and now we're in inning 1, and I still think we have a 3 to 5 bagger on our hands here over the next 10 to 15 years. I just can't get my head around how people have not looked into the analytics here, as the electric cars hit 65% of Norway's sales as Tesla grabs the overall pull. You got to keep in mind right now in Europe, Tesla hasn't even finished the factory yet somehow shipping out of China and globally has become the #1 EV, selling EV basically in Norway. And Norway is the exemplifier of EVs, because that's where the vast majority of the population, over 50%, are using EVs. It's just astounding to me the runway this company currently has. And they're posting earnings, guys, which we have to keep in mind. They had unbelievable, smashed out of the water China sales, right? That haven't even been baked into earnings yet, because we haven't seen what the earnings are going to flip around to. So that's coming up January 26th, which is next week. And on top of that, guys, I just feel like people just, they can't wrap their head around how big Tesla's truly going to be. I mean, I was just working with an energy company and a utility grid company that made a very bold statement saying the utility grid is not set up for electric vehicles. And what people are severely underlooking is this massive shift in growth we're about to see in utilities upgrading their systems, because the amount of megawatt powers that are going to be drawn are going to basically triple thanks to electric vehicles and the electrification of basically the world, when people start perhaps using battery walls. And Tesla just installed a a crazy amount of power walls, like this giga wall basically for Austin, Texas, to start testing out a crazy amount of power storage and delivery, which is just, they're so multifaceted and so far ahead in every aspect of their business that, you know, I cannot foresee how they're not going to own 50% market share in the US, which leads me into the third stock that I'm very intrigued for, and that by all means an ETF, guys, when I start thinking about diversifying into Amazon and I start thinking about Nvidia and all these other companies I'd love to own, I kind of revert back to why not just buy a QQQ ETF, a VOO ETF. And considering I'm finally down on my VOO, I'm thinking about cost averaging back into this because the yields are going to be higher. I'm getting a better discount right now, and I generally love this weighted index. Now, I've been looking at a lot of other kind of portfolios like the BlackRock BST, which I can pull up real quickly for you guys because this is a closed-end fund that I've been talking about recently. But when I look at all these different facets, guys, I'm like, why not just own a weighted index fund? Because people keep forgetting that it's automated with Vanguard, and basically the percentage weightings are based off market cap weightings. So it's all automatic, and it's just you end up with the best companies all the time, and the ones that don't do well slowly bleed themselves away, kind of giving that excelled performance, right? Whereas like these close-end funds are separated from the NAV prices. So like sometimes these prices will not reflect the underlying assets, which basically just means you're trading this outside of the underlying assets. Whereas with an ETF or a mutual fund, usually when they issue you shares as soon as you buy. So you buy, they issue shares, they take your money, they diversify it out. When you sell your shares, they take the shares back, they hand you your money back after selling some of the assets. So it's directly correlated to the underlying assets, whereas these guys are not, but they have excelled. This thing's paying a 7% yield based off some cash flow from options and calls. And it's kind of interesting that if you baked in cost averaging in the dividend over the last, since its existence kind of around 2018, 2019, it has actually outperformed the NASDAQ, which is very intriguing stuff. But I'm always getting drawn back to the simple idea of just the Vanguard S&P 500 index. It's just something you should just always be buying into. And if not that, maybe the global market index fund, which is very similar to VOO, which is obviously VTI. And there's obviously iterations of these companies. There's tons of different versions of the exact same ETF here. So pick any of your S&P 500 ETFs you appreciate. But God, guys, I can't be just throwing my money into individual stocks when I know that this is probably the path through my 30s that's going to be the path of least resistance to continued stability and wealth. And at this point, the ramblings of a madman come to a conclusion, and I pass that question off to you guys. I know I've been talking about a lot of different stocks, watching a ton of different stuff with dividends and everything else in between, but I'm not a PPC Ian. I'm not a Meet Kevin. I'm not a financial education or a Graham Stephan. I'm just doing whatever the hell I do as a Canadian, and I hope you appreciate it. So stay cool, stay awesome, and I look forward to catching you in the next one.